Hello, this is a short video from our longer series on oil and gas accounting. In this video, we're going to go over some illustrative examples for JIB accounting for both the operator and non-operator, as well as a cash call. If you learned something new, please like, share, and subscribe. Without further ado, here's our first seminar on oil and gas accounting and the basics.
All right, so this is just an example of what an entry would look like for an operator. So Rico Resources owns 50% of the Lufkin lease, and then Silver Bullet, a non-operator, owns the remaining 50% of the lease. Now, Rico receives the invoice from Oilfield International for drilling services performed for $1 million. So the following entry will be recorded by Rico. So we will record a debit for a JIB receivable, as that's what we will receive from Silver Bullet, since they will owe 50% of the working interest. We will debit the oil and gas properties for our $500,000, and then we will credit accounts payable for $1 million, because we will pay the full. They will pay the full expense, but then we will receive 50% of it back from Silver Bullet. So once the operator pays the invoice, debit accounts payable, credit cash. And then once they collect the receivable from Silver Bullet, you'll just debit cash and then credit the JIB receivable to get it off your books. Now, from the non-op perspective, same scenario, except for this is going to be on Silver Bullet side. So for Silver Bullet, they will debit oil and gas properties for $500,000 and then credit a JIB payable for $500,000, showing they owe that to the Rico Resources. And then once Silver Bullet pays the JIB, they will get rid of it, the JIB payable, by debiting it for $500,000 and then crediting cash for $500,000. So just auditing issues related to property costs. So a cash call is a prepayment made to a partner or operator. This is due to significant costs involved in the acquisition, exploration, or development phase. It requires a company to pay a cash lump sum in advance for actual costs being incurred. The initial accounting for the cash call will typically be classified as a long-term asset under prepaid drilling costs. Companies do have the tendency to record this as a current asset, so we need to be aware of that. And we may need to create a PAGI for reclassification. It will also, long-term disclosures are as a result of the nature of the cost, so we need to make sure that is included. And then just a little note, classification should be based on the nature of the asset rather than the expected time to be utilized. Utilization of the cash call. This is to reduce the prepaid drilling costs and increase oil and gas properties based on actual invoices once they're received from the vendors. We will need to understand the journal entries and kind of the flow of transactions, and the accounting treatment for these cash calls are going to be the same for both full cost and successful efforts. So just a quick cash call illustration. So once again, same scenario. Rico owns 50% of the lease. Silver Bullet owns the other 50%. Rico cash calls Silver Bullet for $1 million for just anticipated drilling costs in the next month. Silver Bullet gets the cash call statement, but Silver Bullet does not have to record the entry as they have not incurred a contractual liability just because they received that statement. In practice, you will sometimes see companies debit a prepaid and credit a payable at this stage, and this treatment is generally incorrect as nothing has been prepaid. So they do not need to create an entry until that cash is paid in full. So Silver Bullet finally pays the cash in full, so they will create the entry debit prepaid drilling costs and credit cash. And then once Silver Bullet receives the joint interest billing from Rico for drilling costs for $500,000, they will apply that against the previous cash call. So you'll debit oil and gas properties for $500,000 and then credit that prepaid drilling cost.
So let's wrap up there. Comment with any additional questions you may have, and we can expand and help. Please subscribe so you don't miss any new content. Hey, before we continue, let me quickly tell you about a collaboration we are doing with the TB4A Shopify account that can save you some money and help support the channel in the process. Are you an accountant with a sense of humor, but are having trouble expressing that in the third meeting this week about account reconciliations? Maybe you're struggling to find that gift for your accountant friend or their new kid. Or maybe you're struggling to find some not-so-average office gifts. If so, check out TB4A's Shopify and get all the great business comedy gear. They're uploading new items each week. Use my code ACCOUNTINGACADEMY, all one word, for 10% off your purchase. Each sale will indirectly support this channel. Imagine bringing this fun cup to your next pointless meeting. So check out the link and see what you can find. Now back to the video. All right, folks, thanks so much for watching. Please like, share, comment, and subscribe. And if you can, donate at Patreon. Anything you can give helps to keep the lights on and ensures we can continue to create content. And of course, helps feed FIFO. If you want to contact us about anything you saw in this video, accounting advice, or ideas for future videos, contact us at patreon.com/accountingacademy.
This video is designed to be illustrative and does not represent an official position. We make no representations, warranties, or guarantees and assume no responsibility for the application of this material. Please seek advice from a competent professional if expert assistance is required.